Hi, everybody. So, what I want to discuss today is essentially how the Fed rate is affecting banks and the housing market. And it's going to get a little involved, possibly a little complicated, but hopefully I explain it well enough and you learn something about it. And if you don't, maybe educate me. So, with that in mind, let's get into it. CPI data came out last week and it was point two. People were expecting point two to point three, so it came out kind of right there, right where it was supposed to. And the markets actually were happy about that. So they shot up that day, but they didn't shoot up a lot. This essentially uh, is showing that, at least inflation is coming down a little bit. They're saying that it's like roughly around 3% now, year over year. And it's a lot better than 9%, but also remember that these numbers are made up by your government and they omit certain things like food, shelter, basic things you use every day. Um, so just be wary of that when we go over these types of things. We also have a 5.5% Fed rate, which is the highest since the housing crash. I mean, if you look back 2008 and 2007, we were 5.25 just before everything shit the bed and we had basically free money going from 2009 all the way up till right around 2016, raised rates a little bit, crashed it again with COVID, and here we are. And that's basically it's a cyclical thing, but we've been at such low rates for so long. I mean, you're looking at before 2010, we're looking at almost 2 decades of rates that didn't crest 3%, and all of a sudden you're at 5.25. This is going to lead to a lot of things. Besides the fact that they printed $1 trillion plus of money, so there was free money floating around, and now they're trying to squash that and bring it back so that the M2 money supply is dropped. That's going to raise a lot of problems. And some of those are going to be in housing and others in banking because the banks have essentially locked in all these loans and rates for like 2, 3%. And now they can get a lot more money just by having holding on to the money overnight. They can get 5.5% from the Fed rate, and instead they're getting 2 or 3% as the interest is increasing and causing issues for the banks. And a lot of the smaller banks are the ones holding a lot of commercial real estate, which is having vacancy problems upwards of 20%. And a lot of the valuations on commercial real estate have started to just plummet, which is also a problem because in 2025, a lot of commercial real estate is set to be refinanced. If people can barely afford rates now, and businesses don't have easy access to free money anymore, and they're going to have to refinance at higher rates, you can see where this problem's going. You're going to get a lot of foreclosures. You're going to get a lot of regional banks holding on to different commercial properties with no tenants that they don't really want to hold on to. They'd rather loan them, lease them, get them off the books. And that's not going to be a big thing that they can do because no one's going to be looking to buy office space because they're going to work from home or they just closed up shop because everything got too costly and there was no profit margin left. That's just one peg in this problem. The other peg is regular people, you and me, who would like to buy houses. Essentially, there's a problem. And that problem is the fact that you can't get a house loan for under roughly 7% now. And that's a huge problem because, let me hold that. Huge problem. There's a huge problem because at 7%, a lot of people have their house loans locked in at, again, 2 or 3%. If I had a 1,500 square foot house that was roughly 150, $200,000, and I've owned it since 2017, not only has the price gone up, it's probably close to 200, it's probably gone up a quarter, 25% in those since 2017. The interest rate I would get now, let's say I had a 3% interest rate. You're looking at probably over a doubling in your interest rate. So if I were to sell that house for $200,000 and buy a new house because I have a burgeoning family where I just got a new child or something like that and I need more bedrooms, it's going to cost me, let's say it's a $300,000 house, even though I made that 50K on the, house appreciating in value. I'm still going to have a problem because the interest rate's over doubled, which is going to make that payment plus $1,000 a month. People don't have an extra $1,000 laying around. And these are just small houses. I'm talking like tiny houses that are going for well over what they would 4 years ago because of inflation and because of these rates. These rates are going to do bad things to banks because they've over leveraged and they have a lot of loans on the books that are not making them nearly as much money as it could if they were to, loan it out today. Honestly, all they do is if they have the overnight Fed rate of, 5.5%, they're making 5.5% on that money is way better than, loaning it out to other banks or people at 2 and 3%. So they're losing money on that. So there's going to be a lot of regional banks that are going to get in a lot of trouble real quick. And especially if the Fed continues to raise rates because those rates affect the banks in the fact that they can't earn the money if they've already loaned it out. And then any loans those banks hold, because fractional banking, super cool, not really. Like, anything that they, have to pay on the interest of any loans they hold, that goes up, which stresses the banks. So you will probably see more banks collapse. I mean, you had one in Kansas that you probably didn't even hear about that collapsed over the last week. Is this tiny little bank, but it went down. They're blaming it on a scam, but it was probably because of fractional banking. And it's all these. You can see how all these things are related. You've got the Fed fighting inflation by raising rates because that takes money out of the economy. Things get more expensive because of inflation, less money to buy the goods. Therefore, inflation stops because there's less money going after the same amount of goods. Now, if you flip that coin around, there's less money and things are expensive. There's a certain threshold where that starts to hurt people. Jobs get lost because there's not as much need for those goods because not everybody is going to buy those goods. Not everyone can afford those goods. And it's a cycle. It's a vicious cycle that you and I, middle America, pay the brunt of the cost for because people with millions and millions of dollars are collecting interest, no problem. They can live off that interest if they so choose. Um, and then there's the people at the other end who are getting all sorts of handouts left, right, and center. I'm not saying they don't need them, but there are, if COVID showed us anything, it's the wild abuse of the financial safety net because there was so much fraud in the COVID payments and the business payments. I mean, it was upwards, I want to say it was close to a third of all money that was sent out was basically scammed away from the government because the government was in a rush to get it out and didn't do due diligence to check who or what it was going to. Some of the people are being brought to justice. Money's gone. Some of the people are across the ocean, and you're never going to see that money again. So you and I, taxpayer, average Joe, paying the brunt for the actions of Congress that didn't do its job properly. And I'm not talking, political politics, left, right, and center. I'm just saying in general. Every time the government gets involved, things go badly. Things go wrong. It is much cheaper and more efficient for private entities to do things more often than not. But I digress from that point. So essentially, you've got these massive bubbles. People are stuck in their houses, even if they want to get a bigger house because they don't want to pay more than their current mortgage for a little bit bigger house, even though their house is appreciated in value and they could basically have close to a similar amount left over, you know. to put on a new mortgage. The fact that the mortgage is double the rate that they have, why would I why would I leave the comfort of a house that I can make work to buy a new house that's going to cost me an extra $1,000 a month, especially when the price of my groceries, my gas, all that's going up higher. I'm stuck where I am because I can't afford to do that. I'm stuck where I am because I don't want to do that because it would hinder my ability to invest in my own future. So there's a lot of that going around. Not to mention the fact that in a normal market, you will see prices of houses go down when interest rates come up. And what we've seen in this market, which is absolutely crazy, is the fact that houses have continued to rise with inflation as well as having the interest rate go up from 2.5%, 3% all the way up to 7.5%. And there's no good way to do that and have people be able to afford houses. It's pretty wild. So one of two things is going to happen. The real estate market is going to crash back down to earth because no one's buying houses. There's none on the market, which is currently why prices are going up because no one wants to sell into a high interest rate. But now you have no one wanting to buy because the price is so inflated on a house. Like, I mean, around this area, I've looked, and there's little shitbox houses for like 150K that are like maybe two bedroom, one bathroom, and it is ridiculous. There's no way in hell. This is a rural area. There's no reason for it to be. Houses like that should be around 89,000. They're close to damn near double what they should be. And people are getting it because there's nothing on the market and people want to move into a house. So they're overpaying on these inflated rates. And honestly, the only way I can see a lot of people buying houses now is going to be in cash, and no one has 150K just laying around. They have to save up for it. So the only way to save up that much is time. Like you need the time to have a job that makes enough money where you can put a stash, a boatload of cash to buy a house like that. And in the US, we are not good savers. So there's going to be a lot of renters. So it's driving up the price of rent, which drives up the price of houses because those two tandemly go together. It's very eerie to the whole you'll own nothing and be happy montage and motif that you keep hearing about. Um, and it's just wild to me that this is the state of real estate right now. But eventually you're going to have a come back down to earth moment when people just stop. They stop buying and the market will correct. A lot of, uh, you know, a lot of people are predicting that we're done with the Fed rate hikes, and I hope they're right. They're saying there's less than a 28% chance of another Fed rate hike this year, and they're hoping that Fed, drops rates down next year. I don't see that happening until inflation hits 2%. I don't see that happening at all. And we're currently at the government's version of 3%, so no. I don't see it. But if they continue to raise rates, which is going to be wild, that is going to hurt banks all the more. And there are a lot of banks that are traded on the stock market that could be beaten. There was PacWest that almost went bankrupt the last time around. And there's a whole bunch that just got downgraded, and it's not good. And a lot of people are predicting a massive recession because of all these indicators, whether it be the M2 money supply drop, which is the worst since like 1830 or something. It's it's pretty wild out there. And they're still indicating a Fed because, ever the optimist because that's their job. Oh yeah, we still predict we can do this with a semi-soft landing. And I don't see it because every time the government gets involved, bad things happen every time. It's it's going to be an interesting couple years. And if you're looking for a house, I encourage you to wait because like you're going to get into a house at a massively increased rate right now. And you're going to think, yeah, and maybe I could afford this for like maybe 2 years before I can refinance. maybe even three, and then it's going to be 3 years later, and you're like, why haven't they lowered the rates? Why are the rates still at 7%? And then it's going to stay that high, and you're just going to, it may even go up. We don't know. This is why you should never get an adjustable rate mortgage because you don't know what's going to happen. Always get a fixed rate mortgage. Now, 3 years from now, maybe the Fed starts to cut. It depends on how bad a depression we go into. That would cause a rate cut. And a lot of people are predicting one close to the end of this year and into next. So we'll see what happens. But it's a lot of bleak news. So I don't see what there is to be happy for. And a lot of people are predicting the stock market's about to explode. And it kind of makes no sense to me that you're going to predict new highs for the stock market in the same breath. You're going to say real estate's going to crash, everything's collapsing. It, the two don't mesh. Though you have to remember that a lot of people believe that the stock market is a 6 month precursor, like it has a 6 month lead on where markets are going. So the fact that we've seen this up, maybe things are looking up. Maybe this is the end of rate hikes. Maybe this is the turning point. Then again, in every recession and depression, you have these 6 month year bounces that happen. And then everything goes down even further. So what's going to happen? I don't know, but I do know you should be very cautious about the whole thing. So, with that, take care. We'll see you next time.